Many people think accounting is boring, very difficult, and that you must be a mathematician to become an accountant. Very far from the truth. What if I told you that you don't need all of that and that accounting is not boring, accounting is not difficult, and you don't need to be a mathematician? If you can tell the story, the financial story of a business, you can become an accountant. If you can tell the story of the money that came in, the money that went out, and the balance, if you can track all the money that came in and went out, you can become an accountant. So accounting is not that very difficult, mysterious course or profession. No. If you can tell the financial story of a business, you can become an accountant. So in this video, I'm going to tell you what accounting is and what accountants do in the simplest way possible. Maybe you just may consider becoming an accountant yourself. Let's begin from the beginning. Accounting is called the language of business. So accountants tell the financial story of the business. So let's be more formal. What is accounting? Accounting, basically, when we say accounting, we're actually looking at financial accounting. There are different forms of accounting. There's management accounting, there's international accounting, there is green accounting, there is cost accounting, so many types of accounting. But when we talk accounting in this sense, we are actually referring to financial reporting or financial accounting. Now, what is accounting? Accounting has to do with identifying financial events or financial transactions of a business, recording them, analyzing them, summarizing them, interpreting them, and communicating this information to users so the users can make informed decisions. This is basically what accounting is. That's why I said, if you can tell the financial story of any business, you can become an accountant. So this financial story, what is it? We want to know what the profit is in a period, maybe 3 months, maybe 1 year. Every business owner wants to know whether they're making a profit or a loss. So if you can tell that story in a very clear way, you can become an accountant. So we want to know whether we are owing or whether we are being owed, what we sold on credit, what we sold on cash basis, what our bank balance is, basically all of these things. So if you look at all of what I'm explaining, we collectively put them in what we call the elements of account, which we call assets, liabilities, expenses, equity or capital, and income. So we put them into this and we call them elements. So the assets, what are assets? Assets are simply what the business owns. But if you study further, we don't stop with ownership. We talk about control. So if you're able to control an asset and the asset works for you and there's inflow of money into your business, then we say it is an asset. So we'll keep the definition simple at this point. But of course, as you are growing, you can go and look at my older videos where asset is professionally defined. But at this point, just take it that an asset is what the organization owns. Then a liability, what is a liability? A liability is what the organization owes, what you are owing people or owing entities. And of course, as you grow further, you see that the definition needs to be a little bit expanded. But for now, just know that a liability is what the organization or the entity owes. Then we talk about equity. Equity is also called capital. That is what the owners of the business contributed. Okay? So if you want to start a business, we talk about what we call entity concept. The business is different from the owner. You must get used to this in business. Accounting differentiates between the owner of the business and the business itself. That is why when you take out money from the business for your personal use, not for the business, we call it drawings. You have known what a drawing is. Just as you know what an asset is, you know what a liability is, you know what a drawing is. You take out money from the business for your own personal use, not for the business use, because the business is separate from the owner. So we call that a drawing. We also know what capital is, and we say capital is also called equity. So now income and revenue, they go together. So if you make sales, let's say you sold 10 units of your product, you sold 10 units, and the selling price is a particular amount. So you multiply the selling price by the quantity sold, the amount you get, that is your sales. So that is your revenue. And when we talk about revenue or income, so income has to do with more. At this point, when you study further, we may want to differentiate between revenue and income. There's a slight difference, but basically, let's just say your revenue is what you are able to generate. Okay, when you make your sales, what you generate, whether it's a service you offer or a product that is sold, that is your income, that is your revenue at this point. But you can watch my older videos so that we can see a slight difference between income and revenue. So let's not get confused at this point. And what of expenses? Expenses are all these small repairs, some small things that you don't take for too long. You just treat them and write them off. Okay, you don't need to add them to the cost of the fixed asset you bought. We talked about what an asset is. An asset, we say, is what is owned, isn't it? Or controlled. So, having known these basics, the elements of account, the next thing I want to tell you is there's something we call the accounting equation. If you want to study accounting, you have to know the accounting equation like the back of your hand, because it's one of the most elementary things that you have to know. The accounting equation simply says assets are equal to liabilities plus equity. Simple as that, just a small equation. And like every other equation, you can do the subject of the formula. You can rearrange. So if you want to know what liability is asset minus equity. If you want to know what equity is, it is asset minus liability, and so on. Okay? So you can rearrange the formula, but basically we say assets are equal to liabilities plus equity. So that's the accounting equation. And as long as you practice accounting or you study accounting, you will always need this equation. The very simple accounting equation will always be useful to you. If you're going to prepare the balance sheet, which we call the statement of financial position, you will definitely remember the accounting equation. Now, we've talked about the elements, we've talked about the accounting equation. Now, next I want to talk about the statements. But before we talk about the statement, the financial statement, there's what we call the double entry. The double entry rule means that every transaction has to be looked at from two sides. You look at the side of who gave and who received. That is accounting. And that is the basis of what we call bookkeeping. Bookkeeping is like the foundation of accounting. So you have to know that every accounting transaction or every financial transaction has to be recorded in two ways to be complete. So we say the double entry, that is double, two times. You look at it from the side of the angle of the giver and the angle of the receiver. So if I give you an apple, I am the giver. And you that collected it, you are the receiver. So that is how it is in accounting. For every money that exchanges hands, somebody received and somebody gave. If you understand this, you have understood the golden rule of accounting, which is the double entry principle. Now we also have what we call journals. We have ledgers. I'm telling you, this is what the account that should be debited. This is one that's the debit. What is debit and what is credit? Debit is the one that receives. Credit is the one that gives. So once you want to know debit, I can't talk about debit and credit like it's one difficult thing. It's the simplest of everything you need to know. The debit is the person who received. The credit is the one who gave. So when you say debit, credit, if, for example, you receive cash in your cash book has received money, so you have to debit. And then who gave? Maybe a customer gave. That customer will be credited. We've known debit, we've known credit, we've known what is the double entry system. And there is a way for you to know all the debits and credit. You see all these elements of account that we mentioned, the assets, the expenses, the liabilities, the income, and the capital and drawings. You see all of those things. Every single financial transaction will be one of them. There is no transaction you will meet in accounting that does not qualify to be at least one of these elements. So you see the elements of account, they're just very simple. So you can summarize all, irrespective of what you do. It's either you bought on credit or you bought on cash. It's either you bought an equipment or you build the house or whatever. Whatever it is, it will fall under these 5 elements. That's why we call them the elements of accounts or accounting. So back to the explanation. You see the debit and the credit. We've known debit. I told you debit is, you see when you have this T account, which is there displayed, you have on the debit side, you have, that's on the left-hand side, we'll call it the debit. Right-hand side, we'll call it the credit. Now, how do you know? Most people say, how do they know whether to debit or to credit? That is the simplest thing you will meet in accounting. And that is what we call the T account tricks. I've done a video on it before. I urge you to go and watch it, but I will still explain it in this video. In accounting, if you remember the mnemonic, dead click, DEADCLIC, the D stands for debit. The E stands for expenses. So all expenses originally sit on the debit side as long as they are increasing. What do I mean by that? If an expense has been incurred and it's not being cleared out, it means it is increasing. So once it is increasing, it is debit. All assets too take debit as long as they are increasing. Okay? So what does it mean to be increasing? It means you are buying more assets. You are buying more assets. You are getting more assets. As long as you are getting more assets, it is increasing. It will take debit. The next one is drawings. All drawings. Drawings. Do you remember what I said drawings was? I said the business is separate from the owner. So when the owner takes out money from the business for his own personal use, not for the use of the business, that is a drawing. So all drawings, as long as they're increasing, they also take debit. So that is the DEAD. You see, D is for debit, E is for expenses, A is for asset, D is for drawings. So once you say dead, you cannot forget it. Let's look at the credit side. You have CLIC. That's the click. C, the C is for credit. L is for liabilities. All liabilities, as long as they are increasing, they take credit. All income, as long as they are increasing, they take credit. All capital, capital is also called equity. As long as they are increasing, they take credit. So for all those ones that are increasing, if I told you that on the debt side, the debit side, they all take debit because they are increasing, it means they will be decreasing. When they are decreasing, they will not take debit, they will take credit. Those ones on the credit side, I told you that as long as they are increasing, they will take credit. When they are no longer increasing but decreasing, they will take debit. That's the opposite. So once you understand this, I'll teach you more of this because it's very, very easy to understand. Next, we talk about something we call ledgers. I talked about journals. I talked about ledger. The ledger is where we now see them sitting. So for every transaction, it has a ledger. After you prepare the journal, when this is to be debited, this is to be credited as a result of this being blah, blah, blah. That's the journal. So that journal will be transferred to what we call a ledger. And the ledger is a T account displayed there where you have debit and credit. To show you the account that is affected by that transaction. So if it is something you bought on credit, you have to open purchases ledger and so on. So you sold on credit or you bought on credit, you bought on cash, but all of them, you have ledger accounts for them. For every transaction, whether it's a repair, it's an expense, there is a ledger for it. If it's an asset, there is a ledger for it. If it is capital, there is a ledger for it. So this rule of the debt click that I explained will guide you in preparing your ledger. Now, at the end of the period, whether it's monthly, whether it's every 3 months, whether it's every year, you will have to prepare a trial balance. A trial balance is not an account. It is just extracting the closing balances from all the individual ledger accounts and putting them. So all the ones their balances are debit, you put them on the debit side of the trial balance. All the ones that are credit, put them on the credit side of the trial balance. And it is assumed that if you posted everything correctly, it should balance. Where it doesn't balance, it means there are some things, there could be some errors of commission, omission, small errors, which I will also treat. As long as you continue to follow this page, follow this channel, you will learn all of this very easily. So after the trial balance, we now move to accounting proper, which is to prepare financial statements. And there are statements that you need to know. Yes, first, the popular one, the most popular is balance sheet, but let's start from the statement of profit or loss, which is called the income statement. That statement measures performance, the performance of a business. It wants to show you whether you made a profit or a loss for a period. So usually we say statement of profit or loss and other comprehensive income for the year ended. So it is for that year. It is not for the previous year. It is for the year ended or for the period ended. So that is the statement of profit or loss. That's the income statement. After that, you get a profit, net profit for the year or something. That's what you get. Then you go to what we call the balance sheet, otherwise called the statement of financial position, which shows your assets, which shows your liabilities, and which shows your capital. And if you remember that accounting equation that we started, we say asset is equal to liability plus capital. So on one side, you will have assets. On the other side, you will have liabilities plus equity, just like the accounting equation said. So if you remember that, that is your balance sheet, and it will balance. It is expected to balance. To balance means your assets must be, if it is 500, liability plus equity or capital must also be 500. That means it has balanced. Next, we have what we call the statement of cash flows. Sometimes you have a big profit in your business, but you don't have cash flows. So profit could be big, but no cash flows. That can bring about a liquidation of the business. The business can fold up. The business can go bankrupt. So as I said, accountants tell the financial story of a business. And users of accounting information want to get the best information to enable them make the best decisions. Now, if you don't tell them about cash flows, but you tell them only about profit, have you told a good story? You have not. And so they may take the wrong decision. That is why we also have the statement of cash flows, which will tell us of the cash that came in and the cash that went out and what the balance is. So this is different from the profit, which is prepared on accrual basis. What do I mean by accrual? I just dropped a big word. Accrual, there's cash basis and there's accrual basis, or cash accounting and accrual accounting. Cash means you record the revenue, that's revenue, you recognize revenue and cost. So revenue and cost incurred, you record them only when cash is received or cash is paid. That is cash basis. Accrual basis, you record revenue and expenses incurred, not only when cash is received, but you record them in the period in which they occur. So if you incur expenses last year, it will be recorded against last year. If you earned revenue last year, even though they have not paid you cash, it will be recorded against last year. So if it was earned last year, the revenue was earned last year, but cash is paid this year, you are not going to record it this year. You record it in the last year's period. That is what we mean by accrual basis. So I've also explained what cash basis is, and I've explained what accrual basis is. Accounting is very easy like that. Very easy. No complications in accounting. You just need to understand what we call principles, concepts, conventions, and you follow standards. Once you follow this in accounting, you don't have any problem. You don't need to be a wizard of ICT. You don't need to be a mathematical guru. No, you just need to follow standards, understand concepts, principles, and conventions. Now, there's also another statement. There's a statement of changes in equity. Now, equity, as I told you, is capital. What is capital? What is equity? It is the money that is contributed by the owners of the business to run the business. There are two ways a business can get money, can get funds to run the business. It is either by what the owners contributed, the shareholders contributed, which we call capital or we call equity, or it is through borrowing, which we call debt. So usually when we talk about gearing, financial gearing, we're talking about a balance of borrowing and contribution from shareholders. So equity and debt, that's how we try to balance it. And I'll tell you more about this as we go ahead. But for now, I believe that you have also known what is called gearing or called leverage. So we talk about statement of changes in equity. Now, statement of changes in equity here is a statement that shows you the movement inside the capital contributed by the shareholders, whether they have moved from one head to the other. Maybe you have transferred from profit to the capital, and then there's a note to the account. That's the fifth statement, which is not really like the others, but it's a note that explains everything that happens inside all of these other statements. And when we talk about published accounts, we're talking about preparing all of these accounts and posting it either to a website or in the newspaper so that everybody, the public, can see it. That will say it is a published account. And a published account is not complete without the notes, because the people who are going to look at the account, they are not insiders, so they need those notes to shed light on some gray areas, some areas that are not so clear. So all of these things. And there are some things that will not appear in the income statement, cannot appear because the income statement, the balance sheet, the statement of cash flows, the statement of changes in equity, they have a format that you must follow according to standards. So there are some things you cannot put in there as line items. So they have to appear in the notes. The notes are like footnotes. You have to make some explanations there. So as I said, accounting is not difficult. Accounting is not difficult. So there are different types of accounting. You have accounting that focuses on management. You know, you do some internal analysis of costs and profit, and you communicate to management so that management can take decision about the price of their product, about continuing a segment or discontinuing it, and so many decisions that management needs to take.